Hey everyone, Mike here. Today I'm going to talk about two things. First, the reputation of whole life insurance policy, and maybe why it's gotten a bad rap over the last couple of decades. Secondly, I'm going to talk about the structure of our whole life insurance policies, and I'll show you how that may be related to the reputation. Okay, first we'll talk about the reputation. So the reality is that many of the life insurance policies, the whole life insurance policies specifically, that have been sold over the last several decades have been done so in what I consider to be a high commission fashion. Okay, this is done for a couple of reasons, and it's not always a bad actor on the part of the agent. Sometimes it's just a lack of knowledge, but we'll talk through that in just a minute. Okay. Second is the flexibility of these policies that have been sold. And again, it's related to the structure of the policy. Okay, so the way that the policies have been sold, they don't have a whole lot of flexibility built in. Once the premium is set, that's the premium. You have to make sure that you pay that premium in order to keep the life insurance policy in place. Okay, this also means that there's a lot of cash value that might not be able to access in the first few years of your policy. One, because it doesn't build cash value as quickly, and two, because when it does build cash value, the administrative costs are so high that you don't have access to as much of that as you would like. Okay, we'll talk about those administrative costs. Okay, when the agent gets a high commission, it takes away from the value for the policy for the policyholder. Okay, and what that means is that that commission digs into the amount of cash value that would be available to the policy owner. Okay, similarly, if there are high administrative costs by the insurance company, that takes away from the efficiency of the policy as well. Now, in many cases, it's not nefarious on the part of the agent. Okay, the motive isn't nefarious. It's likely that in many cases, a lot of these life insurance agents don't have any knowledge about an alternative way to structure the policy. Okay, others sadly may be aware and are choosing not to do it because they know that it's going to eat into the commission that they would otherwise get paid. Okay, and I'll hit on that in just a minute. I just think that's the wrong way to look at it, okay? The question should always be asked is, what is the best option for the client? How do we set the client up with the best policy for that person, right? So when properly structured, a whole life insurance policy can be one of the most powerful assets that a person can own. And this is why banks and a lot of very, very wealthy individuals keep huge amounts of money inside of a whole life insurance policy. Okay, so I've talked about properly structuring a whole life insurance policy, right? But what does that actually mean? Okay, I've referenced it several times up to this point in a couple of the other videos that I've done, and we're going to get to it now. But I have to warn you, I'm going to nerd out on you for just a few minutes, so hang with me, and hopefully we can get there. Okay, a policy properly structured for banking means that the policy itself is overfunded. How do you overfund a life insurance contract? This is done through what are called PUAs, or paid up addition riders. Okay, what these riders do is provide the policy owner with the ability to build cash much faster than you would do by just paying a premium. PUAs can be confusing, though, to people who don't understand them or people who aren't familiar with them. Simply put, what it means is that you're putting extra money into a life insurance contract. This extra money then purchases future life insurance, and it makes your policy very flexible. There is a catch, though. The government limits how much additional money can be put inside of a life insurance contract. That limit is called the Modified Endowment Contract Limit, more commonly referred to as the MEC line, M-E-C, MEC line. Okay, IRS Section 7702 dictates what the MEC line is. In short, the IRS doesn't want you to have more cash value, more than a certain amount of cash value relative to the amount of death benefit that you have. So the key to structuring a policy is to put as much as you can up to that limit without crossing the limit. Once you cross the MEC line, then you'll lose some significant tax advantages that you otherwise have inside the life insurance contract. So making sure you stay below that line is the key. The way we do this is through the PUAs. Okay, we slap a term rider onto your whole life insurance policy. This significantly increases your death benefit. And when you significantly increase your death benefit, this allows you to store more cash inside the policy. Okay, that extra cash goes towards the PUAs, which are, again, purchasing future life insurance. As a result, the extra cash is not considered current life insurance premium. And sadly, that's why some life insurance agents don't like using these policies. The agent's commission is largely paid out in year one, and it's largely based on the amount of money going directly toward the current life insurance premium. When a life insurance agent structures a policy in the way that I'm describing, he or she cuts the commission by sometimes as much as 60%. But again, the agent should be more worried about putting together a policy that works best for the client and not what works best for the agent. And without a doubt, a whole life policy with a term rider attached to it is the best way to structure this. With a term rider in place, most of the payment each year goes toward purchasing future additional life insurance. We avoid the MEC line and we reward the client for developing an aggressive savings plan. The other benefit of these policies is flexibility. Okay, because a chunk of the payment each year is purchasing future life insurance, the minimum premium required would only be applied to what is your current life insurance premium, right? Let me explain. So the illustration will show how much of your payment is required in order to keep the base policy in place. But for simplicity's sake, let's suggest that it's as little as 40 or 50% of what you may be contributing every year. See, when I build one of these policies, I don't ask how much life insurance does somebody need. I ask how much do you have available to save. So if you're able to save $500 a month, then your $500 would be the amount that we're putting into the policy. Let's say only $200 of this was going towards your current premium. The other $300 is buying future life insurance. Well, if you came into a tough situation for a few months and you weren't able to make the full $500 contribution, the minimum amount you would have to do in order to keep the policy in force would be that $200, so keeping that current policy in place. Okay. Now, this gives you an immense amount of flexibility that you don't have in a lot of other life insurance contracts. Okay. Hopefully now you're beginning to see why we build these policies this way and how we build them. Okay. Next time, what we're going to do is we're going to take a look at how using your private family banking policy actually looks in practice. Okay. If you like what you're hearing, please like the video, subscribe to our channel, and don't forget to turn on the notifications so that you know when a new video is hitting the feed. Thanks for watching. As always, I'm going to put my contact information and our website in the show notes so that you can see where to find us. Thanks for watching, and I'll see you again next time.